we can move on to the next question. All right. Question B. Question B was saying illustrate the above market structure under the following conditions in the long run. So here we're basically talking about a market structure which we don't know, right? We don't know if it is a monopoly or a perfect competition, but all we know is that it is a market structure, right? But again, we're just basically going to stick to the long run. Now, under the long run, we know that for a long run, we'll start with a perfect competition as we can, right? Yeah, we know that under a perfect competition in the long run, a firm produces at the point where price is equals to marginal revenue, and then at the minimum of the average total cost, right? So that is the condition that we follow under a perfect competition. That is where those guys produce. So if price was to be below the average total cost, it means that the firm is making what? Losses. That is under the long run, which also means that the firm will should shut down. So your basically your graph will look like that under a perfect competition. So you are going to have the MC there, since the firm is producing at the point where, so this is where they produce per break even upper, so upper, where average total cost is equals to the market price, and this. So this is the condition that we're going to be following. Price is equals to marginal revenue, which is also equals to the minimum of the total cost. I mean the average total cost. Okay,
Sorry to interrupt you, but is this macro, Michael?
it's micro.
Okay.
Yes. So yeah, so the instruction that we're told is to basically illustrate if a firm is making a loss, or yeah, if a firm is making a loss, right? So we said that for a firm to be making a loss, price is supposed to be below the, yeah, price is supposed to be below the average total cost. So it means that the firm is making a loss because it produces at the minimum of the average total cost in the long run. Okay. The other one is said break even, right? Normal profits. So the break even normal point is the same thing that I drew. This is the break even normal profits in the long run for the perfect competition. Okay, so this is the condition for the break even. Okay, and then for the supernormal profits um, are not possible in the long run perfect competition. Supernormal profits are not possible to be made in the perfect competition because of the easy entry and exit of the firms. So firms can easily enter in the market and move out whenever they want. So bakaona kuangalama nyingi profit in the market, they tend to move out. Bakaona kuangalama, I mean kukangala profit, they'll enter. And then bakaona the firms are making losses, they'll move out. So price will always go back to this market price. So for that reason, there are no supernormal profits. The firm can only make normal profits or can make losses. That is under what? The long run perfect competition. Are we okay with that?
No, can you repeat what you were saying? I didn't get to. Sorry for making go back.
So everything here, these points, everything, 3 points are supposed to be illustrated on the, today we're talking about the what? The whatever market structure that we illustrated here, right? We illustrated the monopoly and the perfect competition, isn't it? So we are going to illustrate in the long run perfect competition when a firm makes losses. In the perfect competition, when the firm is at the break even and making normal profits or zero economic profits, which we are just from illustrating. In the same perfect competition, we're going to illustrate where a firm is making supernormal profits. But I'll say that in the perfect competition, it is not possible for a firm to make supernormal profits in the perfect competition because of the easy entry of the firms in the market. And for that reason, you are going to find that kwakala price yakwela bantu babwela, and there's too much quantity in the market. And when there's too much quantity in the market, it means that uh, you cannot sell. Even if you're a firm, right? You cannot sell because there are a lot of people that are selling. So people even if bafuna kugula kuliwe, they cannot come to you. They'll basically find it somewhere else kwevilili. So yeah, it will be hard for you to sell. So those are the things that we illustrated for Esther Wavela.
nambeera.
Okay. Now, we're basically perfect tense okamba perfect competition, right? So now we can talk about the monopoly. So the monopoly or basic, I remember telling you yesterday to say, a monopoly has conditions like one for the short run, perfect competition, right? So for a monopoly will make losses. Of course, it is also going to be following the average total cost curve as well. If this one is above the market price, it will be making losses, right? And then the break even point will be at the point where the market price will be equals to this point. So this is the break even point condition. Then supernormal profits in the monopoly, moreover, they are possible, they can be made. Of course, this is just supposed to be below the market price, then supernormal profits are made. So that can also be the difference between a monopoly and a perfect competition. While a perfect competition does not uh, is unable to make supernormal profits in the long run, but a monopoly is able to make supernormal profits even in the long run. Are we okay with that? We move on to question C.
I'm so sorry. Can you please repeat on the losses? I missed it.
um, for the losses you just have to, you know that I was talking about yesterday, I was talking about things that differentiate when a firm is making a loss and is supposed to exit in the market, right? You know that in the long run we only are
No,
going to
I'm
be
talking
considered.
about the monopoly, not the perfect competition, just the monopoly.
Yeah, that's what I'm talking about as well. So even for the monopoly, we're also going to be considered in the same conditions. So we know that average total cost, if average total cost is above the market price, you have a curve like that, right? Per, and then your market price, maybe it is there. And then your average total cost comes to be there. It means that the firm is making losses. So this is that if price is below the average total cost, it means that the firm is making losses in the I mean in the monopoly. And then for the, I don't know if someone said was asking a question to do with where the normal profit comes in. For the normal profits, you just have to equate the price is equals to average total cost. This condition will satisfy to be the for the normal profits, either in the perfect competition or in the normal. Yes, Michael.
Can you illustrate the break-even point again? Because I think you set the price equal to the ATC. That's why I was asking you. That's a normal profit or what you're saying in this case.
Okay. So um we can have the market price to be somewhere here, right? This is the price that the firm is selling at, right? So if the break even will just pass here, of the curve that will be tangent here. The curve will be tangent, it will be tangent here. It will pass at this point. So this is a point where price is equals to average total cost. This is in the monopoly. So yeah, it will be like that. So this condition will basically satisfy the condition to be that this is the break even, or the for the normal profits, it's just the same thing as they put it here. they said normal profit, um, zero economic profit, or break even. The reason they put it like this, this is not how questions might come in the exam. This is not how questions might come in the exam. Maybe in the exam they can just cut, say break even nangu, normal profits nangu zero economic profits. One of these words. These words were just put together for you guys to understand, to say they mean one, um, and the same thing. Okay. Um, okay, question C. They're saying discuss the relationship between the following, with the aid of, okay, Michael, you have a question? Okay. Discuss the relationship between the following with the, yes, John.
Yes, I wanted to ask about the break even under monopoly. So, like, is the market structure allocatively productive?
Under a monopoly, those guys, um, they do not produce efficient, outputs. So the part to talk about, the part to talk about allocative efficiency is they are inefficient, not efficient.
Right.
Yeah. Edith, you have something to say? Please mute your mic. Okay. So question C was saying discuss the relationship between the following with the aid of, well, please can you mute your mic? I don't know if she left, the mic on or something, but yeah, let's move on. All right. Discuss the relationship between the following with the aid of well, label diagram. So we're supposed to basically illustrate the relationship between the marginal cost and the average cost. So we know that, even if we're not, drawing the graph, we can illustrate or explain the relationship between the two, right? We know that the graph will basically be like that. We have our marginal cost going up like that, and then we're going to have our average, cost going up like that. So as you can see, these two intersect at the minimum of the average total cost rate. So this is what this is the first relationship that you can give. And then the second relationship that you can give is that when the marginal cost is dropping, right? When the marginal cost is dropping, even the average total cost drops. But it doesn't mean that, um, when it starts, the marginal cost starts to rise, even this one will rise, but because this can be rising while the average is still decreasing. Not until, they meet at the minimum, and then, the marginal pulls the average total cost kwenda kumwamba like that. So these illustrations can just be confusing if you tend to follow the exact things that I'm saying, but you just have to understand how these things are working. Are we okay on that? Right. um yes, Vanessa.
I wanted to ask the relationship between the marginal cost and the average cost. Can you also say like it's also because of the diminishing terms? Like at first it's like increasing. Oh, sorry. At first like increasing in terms to scale, and then constant returns, and then diminishing returns when the FC is going up there. Can say the same thing?
The reasons that you are giving are because of why these curves are U-shaped. Why is the MC U-shaped? It is U-shaped because of the law of diminishing marginal returns. At first, you find that here there's little production, right? And then there's little price that you're going to be. So marginal cost drops. But as you produce, there will be higher cost that you're going to be incurring. And the higher the cost, the higher the marginal cost. So it will be like, to go like that.
Then,
And then,
Christopher,
yes.
can you I think you can even explain like this. When marginal cost is less than average cost, then average cost falls, like what you are from saying. Then when marginal cost is greater than average cost rises. Like, yeah, in a simpler way, you can explain it like that. If you
Yeah.
don't remember the, I don't know, the long cut, you can use the shortcut. You just use the inequalities. When marginal cost is less than AC, meaning that AC does what? It falls. Then when MC is greater than AC,
Yeah.
AC rises. That's all. Another way of explaining it.
Yeah. So like yes, Naomi.
What happens when marginal cost is equals to average cost?
And it is this part. They are equals. Now they have intersected. They are equals at the point where marginal cost is equals to average total cost. Nothing happens. What is supposed to happen? Yep.
Sorry. Wait, Christopher. Can Edith please repeat what she said?
The person that was explaining, please repeat what you are saying first so that Vanvede Vanzak. I don't know the name. Um, what's the name again? Okay. What she was saying basically was she was saying that you can say that when marginal cost is declining, for like when it is dropping, marginal cost is below. I mean, yeah, when marginal cost is less than um okay, let me just show you this. If marginal cost is less than average cost, this one will be rising. That's what she was saying. And then when marginal cost is above average average cost, or um yeah, sorry, I've made a mistake. So this one will be dropping as well. Yeah, marginal cost will be dropping. And then when marginal cost is above the AC, then the AC starts to increase. And then when they are equal, it means that now they have intersected. They are papa. So I don't know if that okay, so this is what she was trying to say with the illustration that she was giving. Okay, now Vanessa added up a point to for my what do you call that, economies of scale. So I was trying to explain to say those things will basically come up with why the marginal cost is U-shaped and why the average cost is U-shaped. Of this one, marginal cost is U-shaped because of the law of diminishing marginal returns, right? And then you find that average cost is U-shaped because of economies of scale. You have economies of scale here and these economies of scale there. So those are the illustrations that you can give in there. Okay, can we move on?
Yes, we can. Thank you.
Okay, question, which one else are we supposed to? Okay, this one, average revenue and marginal revenue. What is the relationship between these two?
You skipped. You skipped marginal product and average product, please.
Oh, okay. I haven't pummeled, guys. As you can hear the way I'm talking, I'm exhausted. You just have to bear with me today. but otherwise, yeah. All right. So if we talk about marginal product and average product, the relationship that is there is that as marginal product is increasing, it is above the this one. Okay, what we're talking about is this Betanzilemba graph, so that you people should be understanding. Of course, here we're going to have this, and we're also going to have that. This is our average product, and that's our marginal product, right? So as the marginal product is above the AP, it will be increasing, right? And then as the AP is less than the AP, the AP will start decreasing. And then at the point where the AP is equals to average product, that is where they intersect. So they meet at the point where at the maximum of the AP. This is the condition that is there. So this is the relationship that is there. There's nothing complicated. Are we okay with that? All right. Yes, Grace.
Can you please repeat on the part where, yeah, on the part for where MP is less than AP?
What?
Can you repeat your explanation on yes, on the relationship when MP is less than AP?
when MP is less than AP will be decreasing. As you can see, MP ilia by papa this line akaka point kekaria back. All this part is less than the AC, right? The AC. As you can see, it is also now decreasing. That's what I was saying there. Are you okay?
I'm not really. Can you please explain? I think I'm lost.
I don't know why you're lost. I don't know. But otherwise, there's I think you're just thinking too much. Don't think too much, okay? Just don't think too much. Okay. So what we're saying is that we have this graph, right? We have this graph. This is for the MP, right? This is marginal product. And then we are going to have average product. Please pay attention, Grace. So as marginal product, when marginal product ilipamwamba pa AP, as you can see, marginal product ilipamwamba pa AP, right? As it is greater than the AP, you find that this AP will be increasing as well. As you can see, it is increasing. It is increasing, right? If marginal product becomes less than the AP starts to decrease. It's this part now, it is below the AP, and the AP starts to decrease, to be decreasing. It's just that it's not drawing a motion, but it will be decreasing, to be like that, to decrease. Bafikana wapi?
Mulidrama mwemuno.
Awe navochitika anyways. So when we now have the MP is equals to AP. This is the point where they intersect at the maximum of the AP. This is just these are just the conditions or illustrations that you can get. Grace Wamvela.
Yes, thank you. I now understand.
Okay, you should try to go through this again once at your free time. I don't know. Yeah, just try to go through these things. All right. They're asking us to basically illustrate the relationship between the average revenue and the marginal revenue. Can someone tell us the relationship between those two? The relationship between the average revenue and the marginal revenue. What is the relationship that is there? Naomi, you have an answer? Yes, Mike.
Yeah, I think the relationship is just the same, just like these other guys. So for me, I think when we look at margin, the margin, when the margin is above the average rises. So in this case, if marginal cost is big, it means the average also rise. Then when the margin is below the yeah, yeah, I hope you get, yeah, something like that.
I like you tried. That's good. Yeah, that's good. You tried.
Sorry, Christopher, we
Hey,
didn't get what you were saying because it was tripping.
okay, okay, guys. Let us avoid when your friend. Of course, we are all here teaching each other. Okay, so mzako akapanga mistake or anything. Let us not send weird emojis to discourage each other. Okay. Yes, Mike. Go ahead.
Yeah, I was saying that I think it's the relationship, the same relationship we have like for the margin, for the for the margin and the average. So when the margin is above the average, it means the average will also rise. According to me, that's what I think. Yeah.
Okay. So that is according to how you think. Someone else with their thinking. Someone else, please. Thank you, Mike. Um, someone else. All right. So the relationship between marginal revenue and average revenue depend with the market structure that we are looking at. Okay. So this the relationship that is here comes from or basically depend on the market structures that we're talking about. So basically illustrate the two. So we have the relationship between the two in the perfect competition, right? In the perfect competition, the marginal revenue um, is the same thing as average revenue. That's the relationship that is there. Vera Mike. So this is um, that. And then when you take it in the in the monopoly, you are going to find that the average revenue, that's the market price, that's the demand curve, right? And then the marginal revenue is there. So the marginal revenue is twice steeper than the AVC. I mean AR. So that's the relationship that is there again. But they intersect at the same intercept. Okay. Yeah, it's good that you tried in your own way, Mr. Mike. But this is the answer. Okay. Are we all okay with that? Okay. Question three was saying that explain the three concepts of explain the three concepts that can be explained using the long run average cost curve. So here you know that the three concepts come from that green thingy that we've been talking about almost every day. We have this economies scale, we have constant returns to scale, then we have economies to scale, we have this economies to scale, then we have constant. So these three, we've been talking about this almost every day now. So do we still need to explain on that? Or maybe we can move on to the next question.
Explain.
Okay, since we've been talking about this almost every day, can someone answer it? Explain. We have three economies. The three concepts are economies of scale, constant returns to scale, these economies. Uh,
Mr. Chris,
yes,
yeah, before you proceed, I didn't understand the relationship between average revenue and marginal revenue. Can you repeat?
we have in the short run, I mean, in the perfect competition, the marginal revenue is equals to average revenue. That is the relationship. In the I mean, in the monopoly, the demand curve, that's the average, the AR, okay? And then this one is the marginal revenue. So the relationship here is that marginal revenue is going to be twice steeper than this one. So that's the relationship that is there.
But they didn't specify.
Is there any other way that you can answer it in the way you're thinking it? That's how questions come. They can't tell you to say it. You have to think now. So that's how the exam comes. Yeah.
Oh, all
Yeah.
right. I thought we can distinguish by definitions.
No, no.
All right.
Um. Okay. By the way, you said that you can distinguish using the definitions. Can you define those two? Okay. I think he has gone. Anyways, so we are basically talking about the concepts that fall under the long run average cost curve, right? And then we've already said that we have economies of scale, we have constant returns to scale, and we have these economies to scale, right? Okay, so those three concepts, can someone try to explain for us, please?
Atwavuate mbwati.
The economies of scale. Explain the three economies of scale.
With what are they? The first one is decreasing returns to scale.
Um,
Mm.
yes, Vanessa.
Oh,
Okay, so I'm just going to try to explain. You can finish it up if I'm not making sense. So the first one, the economies to scale, is when like the the firm is like producing efficiently, so to say. I don't know which other word to use. So it's like they have proper machinery, they have everything that's working. That's like the first part, and then the constant returns to scale is now when the the input equals the output. So if they put one input, the output is one, like the extra one is one. And then for the last one there, the diseconomies to scale is now where the input is greater than the output. So it's like, yeah, something like that. But you can put it in like other words or proper words, but something like that.
Okay. Judith, go ahead. Zulu, you can go ahead. Seems like Judith is not here.
so I think constant return to scale, it is when you increase the input and the output came as the same as you increase the inputs. Then increasing return to scale, when you increase the input, then the output more than doubles the input. You understand?
Can you hear me?
Judith, this is when you're getting me from that time that I said you can start Nango Bwanji. Eh?
Yes.
Okay.
Am I audible?
Zuru is explaining for us. Please mute your mic. You explain once he's done. Okay. Yes, Zulu, continue.
Okay. From my very word, I said return to scale. It is when you increase the input, then the output increases the same as you increase the input. Then increasing return to scale, it is when you increase the input, then the output increases more than you increase the input. What the last one? The last one.
Diseconomies.
Yeah. This economies of scale, it is when you increase the input, then the output reduces.
Okay. So from what Zulu was explaining, he was Zulu. So what you are explaining, a so much cost to explain, you are basically explaining returns to scale. Okay, you're just from the explaining returns to scale. But the question, thank you for that. It's a reminder that you've reminded us on returns to scale. That was helpful as well. So the question was asking us to explain the three concepts that are on this curve, the long run average cost curve. The three, we have economies of scale here, we have constant returns to scale here, and then we have this economies returns to scale here. Okay, yeah. So let me just check what she has Judith seems like what can someone read the message that she has sent? Eh, okay, so that is that. I just said that we've been talking about this all the time, so that's the reason I didn't mention that I'm going to explain anything here. Vanessa said something about it. Mr. Zhu said something about it. So I believe that we can move on to question E, right? Can we move on to question E, guys? I10, I10, you I10, uzilete pa question E, because you are the first one to raise that chimbombo of yours. Distinguish the three types of monopoly price discrimination.
Discuss.
What?
Discuss.
I discuss what?
You said distinguish. So I'm saying that discuss. You have made a mistake.
Oh, okay. Uh, yeah, okay, the same thing. Chawama na menso. Nikademu, I just wanted to see those that are paying attention. Chawama are paying attention.
Stop.
Anyways, yeah, so we are supposed to discuss the three types of monopoly price discrimination strategies under a monopoly. Okay, so we know that we have price three types. Okay, I won't waste much of your time asking what we're supposed to answer here. Let me just do it fast so that we go to the next thing. Okay, if that is okay with you guys. Okay, so from the word discrimination, right? So the word discrimination means that we separate um, how we treat things, right? We have groups, this group, that group, and that group. So the way we are treating this group isn't the same way that you're treating that and that, for like that. So this price discrimination just comes in because of the demand curve that we have under a perfect a monopoly, right? We know that a monopoly is restricted or constructed with a demand curve, right? So the three types of price discrimination basically tries to illustrate how these firms charges the prices kuri bantu mwama balipirisa, because each person has their own quantity and their own price on the market price. On this demand curve, you find that huyu aina yake, huyu aina yake, just like that, just like that. Okay, so the first price discrimination is the first degree, right? Which says that a person is going to be charged according to the willingness. So they will charge you the maximum amount you're willing to pay. They don't care wabwera okamba ati they know that if beva bagulisa vintu at 20 kwacha, right? But iwe ukabwera che from nowhere, no, you come from the village and you think something is 50 kwacha, then they'll tell you to say no, it's not 50 kwacha, it's 20 kwacha. No, they will get your 20 kwacha They won't even tell you to say the price is is 20 kwacha. They'll get you 20 kwacha. They even move. That's that. We move on that. Then question, I mean the second price discrimination is the second degree, which is basically based on the quantity. They'll charge you according to the quantity. So the quantity that you want is the quantity that will determine what the amount. So mapesika venango, you buy a lot of things, then they sell you at a lower quantity. I mean lower price. Wagula kamozi, they sell you at a higher price. So the quantity will determine how much they sell you the whatever things that they are selling you at the second degree. The third degree basically illustrates them to they charge people according to the groups. You find that someone stays in Kalingalinga and there's someone that is staying in maybe Chamba Valley. You find that Chamba Valley, the people that are using solar panels, right? And then ku Kalingalinga uko kuli bantu basebenzesa maningi light. So you find that these guys that are using electricity to demand for electricity more than these people that are using solar panels, right? So our solar panels won't be charged too much compared to the Kalingalinga ones, because bazi bakalingalinga nango vadula bazagula, but bakuchamba valley vikadula sibazagula. So that is that. Yes, Gilbert.
Based on your on the third point there, are you trying to say that they'll be charged according to like standard of living, or in general how an individual like presents himself, as to your example, like the same way Chamba Valley and yes, like what?
No. I'm not basically saying that it depends with how someone is. No, the third degree basically talks about they charge people according to the market that they belong to. Each place has its own market. There are places where something is demanded more than the other place, right? You find that if you go, I gave an example of Kalingalingo because there are a lot of people and we all demand for electricity. Okay, let me just give this illustration or this example.
Or like
Pajapamene,
the place, like according to like the area or the place itself, like there are less people in Kalingalinga, then let's say there are
yeah,
more people in Kalundu.
some
They there
something
was
like that.
this there'll be more people that would want to like buy a certain item in Kalundu rather than Kalingalinga due to the fact that there's more people there, right?
Yeah, something like that. It might come to that, but the main illustration is just with the markets. Yeah. Yes,
Okay.
Vanessa, you want to add up something?
Yes, I wanted to say it's not necessarily about the people there. It's about like the demand of the thing. Like the stuff for Kalingalinga and like let's say a suburb area like Ibex. So for electricity, you're going to say that people in Kalingalinga can't afford solar panels, they can't afford gas stoves, they can't afford all of those things. So they need power running 24/7 for their houses, for their businesses and everything. But then people on the other side, they have like other substitutes. So they can do solar, they can do gensets, they can do um, gas stoves, everything. They have substitutes. So power is going to be more expensive in Kalingalinga compared to there because they know to say, even if they put like 1 unit is 50 kwacha, people are going to buy because they need the power compared to like IBEX. Because if they just put, let me say for example, if power is 20 kwacha per unit and then they change to like kwacha per unit, then the people are just going to be like, "Ah, we won't buy power from you, we'll just use solar." So it's like it depends on the demand of the said commodity.
Okay. I believe she has explained everything, right? Okay. Yes, Zulu.
Oh yeah. Just to say to space on this point, I think let's not talk about like the places because we'll divert from the actual point. Let's focus on the word markets. It's charged according to the type of market you belong to.
let's say for example, if someone, the way she already said, yeah, if someone is in ibex, then even if you are from Kalingalinga, you go to ibex, they won't charge you according to your place. No, if you go to that market, they'll charge you according to that market. Yeah, I think that's the case. When we talk about places, we divert. Okay, so that is also a point that we're supposed to pay attention to, right guys? Okay, I think silence will mean that everything is okay. Let us go to question 2. What time is it? Just a minute. Okay, we have about 30 minutes to go. Okay, the following demand function for good X, which is mojo drink, has been estimated as the function that we've been given here. So this is the demand that we have, the demand function. You know that the demand function is going to have, of course, the thing that is being demanded. So this, there are two goods here that are being demanded. We have good X, we also have good Y. Then we have income, then we have this constant um, number that we have there for the function. Okay, yeah, so they've told us to say if the price for good X is equals to 200, the income is 20 quarter, then the price for good Y is 150. Question A, graph the demand function for mojo. So for us to find this, we're basically going to find the demand function for mojo. So for us to find the demand function for mojo, you know that we're only going to have mojo as the only thing with a P, right? Because this is the thing that, so apa tizafunga tapeza namba ilipo, napa tapeza namba ilipo, namba tapeza namba ilipo, then we'll just leave this as the only number that we have to have there. So the basic thing that we're supposed to do is first find the quantity that is kulaku first kusumameni. So having those numbers that we have, we're basically going to say our quantity is equals to our quantity X is going to be 2. Mama calculator, please in Pempako, because I don't have a calculator near me right now. So 2000 plus 15, we have the income is 20, right? 20 minus Rwandania Esther
Oh, sorry.
Nyabwanji.
Sorry, nilikuwa nataka calculator. Yeah.
akagona ongera tuli.
Yeah, you're saying you're good too.
Okay, negative 5.5. Then the price for X is what? The price for X, we have 200, right? So we'll put 200 there. Then plus is it plus? Yeah.
Yes, but I just want to correct you where you like negative 5.5, you put 3 instead of 5.
Awe mayo ni 5. Ile moneka 15. It's 5.
And also, are we, Gamanic, is it a demand scale? Sorry, I'm trying to ask, are we deriving a demand curve or a demand function? What's the difference? Someone please let me know.
About deriving a demand function.
And be like
demand yeah, do you want now? So far, demand right?
Like, but what we are doing here, what we are finding here, when we're substituting these numbers, we are finding the demand function. Then when we find the demand function, the answer that we find, that's when we now draw the graph, which will now become the demand curve, the one which we draw. This one is the demand function, the way it is. The one we're finding here is demand function. Then when you draw the graph, now that's when it becomes a demand curve. You get?
Okay. Yeah. So this is QX, right? So can someone punch on the calculator? Can you punch 2000? Yeah, 2000 plus, yes, Zulu. 2000 plus 15, open bracket, 20, close bracket, 5, negative minus 5.5 open brackets 200 close brackets plus 0.5. okay, the same thing that we're just replacing there, right? If you find
1000
yes, 1000 what?
275.
Okay, so this is the quantity that we found, right? So for us to fully have the demand function, we're basically going to have here we have 2000 there, right? This is the 2000 that we have there. Mapamanje, we just have to find the demand function for, this is the full demand function for two goods, the income and everything. But we only need a demand function for what? For module, only module. And then for only module, we're basically going to have this part and then whatever number that we're going to find there. So it will mean that we'll get power we have y, we'll replace we're going to replace 150. While we have income, we're going to replace 20. But pari p will just leave it the way it is, and then pari q will replace what? 1200. That number. Can you try to punch that? Fast using number, Kyle. Otherwise, must understand Venicamba, right? I hope move it a Venicamba, not che once point. Okay, guys. For us to find here, but use that graph the demand curve for module drinks, right? So it is only for module drinks that we are basically going to focus on or concentrate on. But as you can see, we have this demand curve that we have here is not only for module. It has this module is px, but we also have py there. So we cannot use this demand function. But also we are going to use another demand function. But how are we going to come up with that demand function? So we can come up with it if what there is, we are going to ignore this part, right? Apa we replace what is supposed to be there, which is 150. Pari wire patisafaka po 20. Kwasira calculate. And then apa we create a pesa, indeed 1275 tachuko pesa. You just replace it there. Then you punch, then that's the answer that will come to that part. I don't know if I'm making any sense. Yes, Jack.
So bino kwamba negative 5.5 px ingana subject to the formula or what?
Boss, there is a bonkala subject of the formula, manji.
Okay.
Okay. I'm still waiting, guys. Mulibema calculator nango mufuna nikupaseni yanga. Nakuza night I don't have manjini. Then you're still waiting for me to answer.
Oh, boss, this overtaking things.
Time. Okay, we have
Okay, Justin.
1007 is equals to 2000, right? Then plus 15.
Now I found this negative 200.
Negative. Ahereni mwapeza bwanji negative 200. You, I don't trust you.
Let somebody else do the answer.
Awe.
But that's what I found.
Wina ngapeza chani.
Because you're clicking everything this side. And then my pressing it too.
Okay, tuone chetu viza chitika hapa. Okay, manje onankon guys.
13.6.
Iyo wapeza chia? Uyo wina ngapeza 18. You guys.
13.6.
Okay, how come mpeza mansa yosia?
Rebecca calculator kwa kwani Kristo.
Ikachet pembe manje. Okay, guys. So this is what we're talking about. We have the form here. The first one is what? 1000. Okay. We have 1200 275 there. The first intercept that we're going to have is that we have 200 open bracket, 200, 200 plus 15 open bracket 20, right? Close bracket. Manje hapo 20 ilipo. Tuenze mbasamu yamwe.
2000 wakamba 2000
Ni 2000 ndi mwapeza?
2375.
yeah, mufungo lemba 2000 I'm not 200.
I'm saying the answer is 2375.
Okay, 2000 chana nko.
2375 that yanko.
Somera chanko.
2375.
2375, bro.
Okay, boss.
Mwakanseni mushi
So imanje ndi amene yai. So basically utikapeza hiyo, it will mean that we have negative 5.5 p. Tisasta divide ukute. Now tisasta divide pa. Tikasta divide it pa sacha. But isankale negative because if ngala positive, not negative. So I don't know how you did your calculation, but it is supposed to be positive. What's the answer? Answer ifunga kupasa 431.
431.818181.
Okay. So yameneyo ndi answer yo manje iyo. The answer yameneyo manje. So those are the intercepts that we found. So there are intercepts that Esther ukonda kamba maningi. Esther, why do you like talking for like that?
I have a question, Christopher.
Yes, if you have a question.
I'm saying the final answer. We're supposed to round it over to how many decimal places then?
You can put it more funira madeko yako ngatufuna ngafake vonse. Ngaufuna kanga pere pamene ufuna but pe ufunira che. So we know that the demand curve is like that. The only things that we're looking for is the intercepts. We found the intercepts for the X part to have 431.8 and then for the down part to be 2075. So these are the intercepts that we're looking for. That's all. Yes, Jack.
So my negative mpere out. Naijati 1275 naye mpere out.
Ibenchi ito ija. That's ija inzo chitandiza chekupeza answer. Answer negative it Jack. Mwezi mapanga chema mistake posta calculate but there's no negative.
But paka pali 5.5 guy negative guy.
Wow, this will be hard way. You guys, why am I flowing patience zero kansha? Okay, but there's no negative, okay? There's no negative. If you calculate properly, you find that there's no negative here. Yes, do move in there. Move it there. Yes, move it.
Oh yeah, Christopher.
Yes.
So the applying, oh yeah. So when you multiply, it's a guy means that person that one 2275. That one is when you calculate on the other side. Then let's not forget that there is the function is a meter step up first to qx. That's 1275. So which means that when we bring the 2375, we'll do 1275 minus 2375, which will give us a negative 1100, which is equal to negative 5.5 PA. Then you divide, so you divide the negative 5.5 and the other side, which means that the negative will cancel. So your answer will be PX is equal to 200.
Oh.
Samia was available.
Okay. Manje,
And that's how I found the negative 200 as well.
okay, guys. So in a me, I'm not saying anything here. All I said is that because most of we are finding these things together, but all I know is that kukufunga konkara 431 something like that, and kukufunga konkara 2000, not in 1 point, but there are no negatives here. Okay, that's what I know. Okay, if mukangana na free time muzaka space, but you understand at least as long as you must understand concept yet and 7 sign, then that is how we found it. So yeah, so this is the answer for question A, guys. Without wasting time, let us just move on. Muzaka peza mairo muzavi peza lero pogona, I know kondo verenga maningi. Yeah, and then my answer was a peza ukafuna peza weka. Anyways, question B is saying that determine the own price elasticity. Hapa without even wasting time, kwamba seven sama formula chani, on price elasticity, we have the price for the goods in module, right? E hapa module E. So hapa pali P, we just get the price for module 200, we put per 200 per. When we divide it, mwaikumbuka ija one pin something ija imwezo kamba mwaipeleka kuti. Wemwenzo funsa tumwaipeleka kuti. That 1000 comes in now here. Yeah. You divide it here. 1000, the same number, that one, you divide it here. That's how you find your own price elasticity for B. For C, they are saying determine the own price appearance of no combat the cross elasticity of demand. So the cross elasticity at Bond boss.
Oh, sorry. I just wanted to ask, how did you know what they wanted to say?
How did I know what they wanted to say? How many price elasticity? How many elasticities do we have? We have price elasticity, right? We have income elasticity, right? We also have cross elasticity. See at that yet and 89. So there are three. Since we have price elasticity up, then the income up, it means that we're going to have the cross one here. So I mean, so there's no big issue where how I know anything like that. Okay, so for the elasticity, for the cross elasticity, we just cross it. We find we do the same thing that we did for the first one, but we divide. We use the other good, which is this one, good. So upper again, we're just going to replace 150 there over the same 1 pins 75. This one, the answer will be given again. Then for the income elasticity, where there's income, we have income here 15 y. We just replace where there's income 20, we divide it again with 1275. Again, it is a pesa mini answer if you can part. That's all. Any complications, guys? Okay, we just have 15 minutes. I think from everything that we've said, I think I'll leave the 15 minutes for your questions, guys. You can ask questions about today's class, everything that we've talked about. Any complications, any confusion, anything at all, you can ask. Feel free to ask. And
inengafuna kwachona oi ukayambia boche yanankanija iyi calculations yafuta bene ya mojo nanankanda sinamvere
these calculations were simple, guys. It's just that Karima konda kuganiza maningi. Yeah. Okay, anyways, tizakafichita in person once we meet. Okay. Is anyone in here is there any person that is interested to present? Because yeah, is anyone interested to present? If you're interested to present, can choose a question then you present for your friends. Guys, Maonaka, you people complain to say, okay, am I rude, you guys? Complain that I'm rude. Christopher does not let
Yeah,
us talk. Oh, he does not let us do what shani. Yes, yes, Mr. Zoo.
Also, you mean like I can choose any topic?
Vofu unaweka.
Okay, I think next time it's okay.
So you guys, you complain too much, guys. No, I'm rude. Me, am I rude? In the emotion. Oh, I love you guys. That's the reason I do like this, guys. I want you people to be better people. That's how it is. Novelaka? Yes, now.
Please repeat question 2B. I don't understand how you answered.
Question 2B. They were basically asking us to determine the on price elasticity for module. And for module, it's what? It's this part, part. So I'm just going to say 5. Sorry, let me just move this. Okay, 5.5. We have px. Px, we've been given that px is 200, right? We say 200 over the 1000 that we found, Paja, 1075. Then yeah, that will be our answer. If we multiply and divide with that, whatever answer that we're going to get, that will be our own price elasticity for module. And then for the on price, this one they just repeated it, and I said that they meant to say cross elasticity, so we use this one instead of this one. So yeah, we use this one. We know that py, the same thing that we've done here is what we're going to do there. Py, the price for py.
So answer will be negative 0.863.
I mean you.
Okay, I now understand.
Yes, Collins.
Yes, sir. In finding the elasticity, what about that formula of using the derivative and associating it with the slope of the prices?
Okay. You mean for the on elasticity, where you can okay, how can I put it? So if you say on price elasticity, then you say that I don't know if this Casimbo is alpha or something like that, but you can basically say, okay, dy dx, right? Let's just say change in quantity over change in the price, right? Times the price, which is here, price times that quantity x. Even this one is going to work. It's just the same thing. So this part E, change in price and over change, I mean change in quantity over change in price. It's just the same thing as what I was saying, because all this part will only be 5.5 times the price. The price will be 200, right? 200 over the quantity. It is that quantity that you found, which is 1275, right? If you multiply this, it will just find you, or you find the same answer. Okay, Mr. Collins. Okay, perfect. Any other questions, guys? Any other questions? Okay, yes, Zulu.
Yeah, this question goes to everyone. I just wanted help on this. Yeah, when you were explaining about the supply curve of a monopoly, what did you say?
Can someone answer that? Yes, Mr. Collins.
The supply curve in a monopoly doesn't have a supply curve.
Why is that? Can someone give us a reason? Yes, Maureen. Okay, I think we all know, right? We all know. Or almost as easy, but do we know or we don't know? Okay, we know why. Okay, we move then. We call it a night for today, but before we go, can someone pemperera for us, please?
Before you pray,
Hmm.
I made a mistake. What's the supply curve in perfect competition?
The supply curve in the perfect Oh, okay. So which part? The market or just for the firm?
The market.
In the market, the short run it is upward sloping. The MC above the AVC. Yeah, the AVC. Then in the long run, it is horizontal. It is just the same marginal revenue curve, the price and the demand curve. That's the supply curve.
Or like I was confused when I was reading. I found something like it's the marginal cost above the average variable cost, right?
Yeah, that's for the short run. Yeah,
Oh, for the short run.
yes.
So I was asking myself, in the long run, we don't have a supply curve or what?
Oh, okay. We do have, sir.
Thank you, sir. Thank you.
Sure. Okay. Can we conclude for the night? Someone to pray for us, please.